right. Welcome to the show, everybody. TSP Weekly Podcast, brought to you from somewhere in Northern Virginia. We are preparing for, what do they call it? We already had snow.
We had Snowmageddon.
Snowmageddon. That's what it was. And then something else we had. There's going to be a blizzard for Northern Virginia. I think for a lot of part of the country. But by the time this actually airs on Sunday, because this is Friday afternoon for us, we'll all probably be stuck at home.
Yep, probably. Hopefully shoveling out a little bit, but yeah, Sunday night will be the
I'm just going to let it melt. I got a Jeep if I need to get out, and but I don't plan on going anywhere. It's the beauty of being able to work from home.
Very
Just
true.
sit there and let it melt. I don't even want to mess around with these people who don't know how to drive in the snow. It's crazy.
I was in the grocery store yesterday. I thought I was getting there early. Oh, no.
I went earlier in the week because I just saw it on the forecast. I was like, I'm not even chancing it.
Yeah, well.
Yeah, so wherever you guys are from watching this, let us know if you're in the blizzard too. There's probably some places, up farther that are really going to get hit. I don't know. It's random because like a friend of mine in Houston is worried.
Texas the governor came out last night and put out a state of emergency for the whole state.
Oh, wow. Yeah, I rarely watch the news anymore. So, if I don't read it in the newspaper. I read the newspaper. It's on my iPad. But if I don't read it in the newspaper, I don't see it. I can't deal with cable news anymore or whatever. Anyway,
this week was quite the cable news week. I'm sure you heard some of it, if not all of it, on the iPad. But holy moly!
Yeah, I try to remember. Someone once told me early on, price is the only thing that matters.
Yes, sir.
So I was kind of going back over some technical analysis stuff. I watched a webinar from CMT folks, right? And I said that like 7 times. And I was like, you know what? Yeah, it is true. So yes, all this stuff does matter, meaning there is a why to it, but it doesn't really matter. Like the price is the only thing that matters, C fund, S fund, I fund are where they are, and how they got there.
There's going to be a narrative of how they got there after the fact.
Yeah, absolutely. Much easier to do after the fact.
Yeah. One of the interesting things this week, actually, we're not going to really talk about it. I don't have any slides on it, but the Greenland issue dominated the news. But arguably, a lot of people argue that the spike in Japanese interest rates is really what tanked the market on Tuesday. A lot of stuff happened over the last weekend.
Yeah, and that's not going to show up. That's not going to be louder than that other noise, right? It's much better it's much better for them to be talking about Greenland or Iceland or whatever. I did hear that somebody messed it up. I don't know if it was the president or somebody kept calling it Iceland and they meant Greenland. But anyway, I
called it Iceland because it's icy.
Yeah, well, I wouldn't know the difference on the map right now, probably. But so you get below the surface, and it probably was. Something else in the economy that made that happen, not so much. Or it could have just been a combination of both. And
for sure, it's a combination. I mean, there's so much going on. The sensational things definitely get the news, but generally speaking, the boring things that nobody wants to pay attention to are the most important. And interest rates around the world are by far the most important thing that's happening this year, probably.
Yeah,
and
for sure.
When Japanese rate spike, it puts a lot of fear in the market in general.
Yeah. I mean, a day like Tuesday can really rock your world if you're hyper focused on what's happening any given moment. If you don't take time to just, zoom out a little bit, and we used to talk about this a lot more, when you're doing this, you want to find where your kind of start point is. And, if you're doing this, if you're making your allocation decisions on a weekly basis, which is what we generally recommend, not on a daily basis. So that means you would generally be looking at weekly information, right? Weekly charts, weekly whatever. And that's a lot easier because it all happened during the week. You take a look over the weekend and set yourself up for the next week. And then the zoom out would be go to monthly, right?
Yep.
Maybe farther out for longer term trends and things. But start a weekly, maybe zoom in daily just to get a sense of what's happening, and then back to month. But you're really focusing on weekly. That makes your life a lot easier. It also quiets the noise.
Yeah, that's the trend. I mean, the weekly charts are the best trend, I would say, that we can follow in TSP to make reallocation decisions.
Yeah, you can do monthly, but you're going to have less you're going to have less opportunity to whipsaw, sorry. Meaning you got in a little too early or got out, got in and out back and forth, right? That's whipsaw, which is like, oh, it changed on me, right? So that happens less when you're at the monthly level. And the weekly level, it can happen. It's rare. Daily for sure. Like if you'd have jumped on the information Tuesday, you'd be right back in today or whatever, right? Like you would be just like, and there's your two moves. So yeah, weekly. I like to talk about those kind of things kind of in the front end of the podcast now. I try to think of little things that we used to say a lot that we don't say much anymore because we're talking a lot about the economy and in economics. And it's good stuff, obviously, because this is the place you get to see all that and see how it's impacting the TSP. And so you can make better decisions. But at the end of the day, there's some pretty simple rules. And most of all, if you guys have been watching this or you're new to watching it, we have an ebook. It's free. You go to our website. It kind of lays out, what we would call our thesis, I guess, for how to manage the TSP. And it lays it out really simple. And so take your time, go take a look at it.
Yep. I would definitely recommend it. All right. TSP Weekly Podcast, 25 January 2026. So take a look at some of the economic highlights this week, but the news anyway, was dominated by Greenland, and the taco trade is back. We'll take a look at historically we have a mid-January dip, and it's a pretty interesting chart that shows that it happened literally on the day that historically it happens in January. Take a look at some of the kind of metrics we can use to get a sense of the condition of the rally. And the bonus chart is the Magnificent Seven. And then we'll look at TSP fund direction. So like I said, interest rates is the most important thing happening. The 3-month, 6-month, and the 52-week bond auctions sold a little bit higher rates this week than the last auction. So we paid a little bit more this week for investors to buy our debt. And that adds, relatively adds more to the national debt than it would if we were paying less for those bonds, if we were paying investors less to buy those bonds. And then kind of more importantly, the 20-year bond also sold higher. And that's the one, so the yield on the long end of the bond curve, the 10, 20, 30-year bonds, is not coming down, even though the Fed is lowering rates. 30-year mortgage dropped from 6.18 last week to 6.16. So the 30-year was down a little bit over the week, but mortgage applications actually fell. The rate of increase fell. They were up 28.5% last week. So last week was a good week for mortgage applications, and they were only up 14.1% this week. The big thing in that sector was pending home sales. Absolutely collapsed month over month in December. It was the biggest drop since COVID, since April 2020. And this is a chart of what that looks like. I did a 10-year chart on this to give some perspective. If you zoomed into a 1-year or a 3-year, this line looks huge. But when you zoom out to the 10-year, it's still really big. I mean, we haven't seen pending home sales this low since COVID. So, it's a combination of people backing out of contracts that they did. Rates are still high. People aren't selling homes because anybody who has it is generally in a rate that's much better than what they would have to move into now. But it's not good as far as affordability and people trying to buy houses, it's not good. Okay, on the positive side, GDP. So GDP is people talk about it all the time. It's it's pretty simple. It's the total monetary value of all goods and services that are produced within a country's borders. So it doesn't count the things that U.S. companies outside of the U.S. make. It only includes the things that are made inside the United States over a certain period of time. It's usually annuals GDP. It shows how much value a nation generates.
And so that would be just so like, I want to be clear in my mind. And if Apple makes something in another country, that's not counted.
Right.
Right. So it's stuff that's made here domestically, regardless of where the company may make more things, but they're making somewhere else.
Yes. Yep.
Okay.
Yep. It's just trying to define goods and services that we make and that we can export. Really, is why that number's there. Because if we can obviously export more than we can import, then the economy is doing well. So GDP for the third quarter of 2025 was 4.4%, which is great. It's the strongest GDP growth since the third quarter of 2023. And a lot of that was consumer spending was up 3.5%. And they talk about this K-shaped recovery. I mean, I don't know about you guys, but things are expensive and my consumption is definitely way less. This 3.5% consumer spending uptick is like the top 1%. And they're the ones that are carrying the economy, and they're the ones generating this 4.4% GDP. So
that's most of Loudoun County and Fairfax County. And I mean, we live in the richest counties in America. I don't know who we're not in that category, but it seems like everybody else must be. But yeah, I can see us dragging. We're like the Magnificent Seven for consumer spending, probably, right? Northern Virginia, just in general.
Yeah, there's a few pockets, and Connecticut and Northern California and Boston.
They always have been. Yeah. But I think we have to be. Well, we are the largest. I mean, we're the richest counties, like number one and number two, and it's so many people. I could see us being sort of the Magnificent Seven of consumer spending. Like we've got to push that up at least a percentage point.
I'm sure. I mean, you look all the defense contractors and aerospace. I mean, the aerospace stocks right now are insane.
Yeah, I went to Tyson's Corner yesterday to visit a buddy for lunch, and it reminded me how much money is just. There were more Maseratis on the road than Hondas. It's crazy around here. But anyway, if you don't live around here, I'm just trying to kind of point that out. We take it for granted that there's we are in a bubble for sure in Northern Virginia. The rest of the country has to be feeling this a lot different than we do.
Yeah,
we're just used to the pain anyway. Like it's always been expensive here.
Yeah. But exports surged, so that was a big part of it, and that was good. Exports is us, sending goods and services overseas, which is a good thing for us. GDP growth. So this is a 3-year chart, and as long as GDP growth keeps going up, recession is not in the cards. The definition of recession is 2 negative quarters, or 2 quarters of negative GDP growth. This could have been the first one, and then we had a 3.8% in the second quarter of 25. So there's no recession. We could be in a recession now and we wouldn't know it because we'd have to wait for these numbers to come out and have to have 2 consecutive quarters, before they call it a recession. So you're at least 6 months behind when they call that. But we talked, I think last week and the week before, we talked about unemployment, and as long as unemployment, doesn't accelerate to the upside, there's no recession happening. Might feel like it if you're on the one side of the K versus the other side, but overall, that's where we're at. So initial jobless claims in the U.S. inched higher a little bit. It was 200,000 this week, but it was way below market expectations of 212,000. And also continuing claims fell by 26,000 to 1.8 million, remaining under averages from the second half of last year. I think it's kind of cyclical and seasonal, though. So this is a 3-year chart of initial jobless claims. And you can kind of see at the beginning of every year, right, that the initial claims tend to fall. And then they kind of ratchet up in the first and second quarters. So it'll be interesting to see what happens this year going forward. But for right now, as long as initial claims are falling, unemployment is not going up, and that's a good thing. Okay, so the big news of the week, Greenland and the taco trade. So last weekend, Trump announces the imposition of a 10% tariff on 8 EU countries beginning on February 1st, and then it was going to escalate to 25% on June 1st unless they could reach some kind of deal on Greenland. We had a holiday on Monday, and all this was happening, in Davos, Switzerland over the weekend. And so when the market opened on Tuesday, it was a rough day. The market was down over 2%. Precious metals jumped. Tech, Bitcoin, and U.S. bonds all fell. So it makes sense that tech would go down. Bitcoin, everybody's had been talking about as a store of value. It's not acting that way. And the fact that bonds went down, I think, is the most important, because flight to safety is supposed to be a flight to U.S. bonds, and that has not been happening for a while. Then on Wednesday, everything flips, right? Trump announces that they agreed on a framework for a Greenland deal. He backed off the 10% and 25% tariffs, and the market recovered on Wednesday. It was up 1.2%. And of course, the media called that the taco trade. Trump chickened out on the tariffs, and that was the spin. That's fine. This is what it kind of looked like if I put up this chart for a few reasons, really, but this is a 1 hour chart. So each one of these red or green ticks is 1 hour. And, you're not using this to figure out if you want to reallocate in TSP, but this is just kind of to prove a point. This was a high in October, right? Pretty close to the end of October last year. The S&P basically hasn't moved since October last year. We've gone up and down a little bit. We got a pretty good support and resistance channel there. We need to break through it to the upside before we get any, sustained potential for any sustained rally from here. And it's been like that for a few months. It's good that we put in that November low, and then we got, more or less higher lows. But we definitely need to hit that 7,000 number and get above it, because that's a big mental, usually round numbers, especially ones that are in the thousands, they tend to be a magnet. Like, price gets pulled up to them, and then they a lot of times have a hard time getting through that level for a while. So that's kind of what's happening right now. It's bumping up against that 7,000 level. But it's been consolidating, and it hasn't been going down. It's been consolidating sideways since October. So that's actually pretty bullish. This was the gap down on Tuesday. And the market continued down, bottomed out, and then that green line was when the news came out that they had some kind of deal on the framework for Greenland. But what's interesting is it came up, hit that resistance channel, and rolled back over. And so what has to happen next is the market's got to fill this gap. We got a pretty big gap there. Tried to fill that gap by the end of the day on Wednesday, and that didn't happen. And then Thursday, Friday, like we're recording this at about noon on Friday, and we're about up here somewhere. So hopefully by the end of the day we fill that gap. Hopefully sometime next week we take out these highs. But we're certainly not out of the woods yet. We're well within the trading range that we've been in since the peak back here in October. So it's just basically, I just wanted to put this up here as a way to get your mind around the, you see the price go up and down every day, and you have to have some way to make it relative to something. And so on the downside, this is definitely an important low. And on the upside, we have to get above this high. So everything that's kind of happening in the middle isn't really all that important. All right. So historically, we get a mid-January dip. I put up, it was the same chart last week or the week before. We've been talking about the cycles and the presidential cycle and the decennial cycle and the years ending in 6 and all that. And it's pretty interesting. Ned Davis Research does a lot of really interesting chart work. And this was the day, that was Tuesday. And historically, it's the bottom of this January pullback. And so if we get, a January and first quarter for sure in line with the historical norm, where this is a buying opportunity, right? And the market goes higher into April. And so I would be watching this chart really closely, because if we, we're looking for some volatility here in February, and then the market picks back up in March, tops in April, and then, 2 pretty good corrections later in the year. But I just thought it was kind of fascinating that we bottomed on the day that historically January bottoms. All right, so condition of the rally. So we've been on quite a rally since last April, right? This is the April bottom from 2025. This chart is the Magnificent Seven divided by the S&P 500. That's in black, right? And then the S&P 500 itself is in blue. So we all know the Magnificent Seven has been driving price higher for since at least 2023, right? For a long time. So the concern right now is the ratio of the Magnificent Seven to the S&P 500. When it's going down, it means the S&P, the overall S&P, is outperforming the Magnificent Seven. So on the one hand, you could say that's good because the rest of the sectors are starting to catch up. Big tech might be pulling back, and the rest of the sectors are catching up. So you could say that's a broadening of the rally, and that's a good thing. That's one way to look at it. The other way to look at it is to say that big tech is so dominant in the S&P 500 that if it continues to roll over relative to the S&P is going to roll over with it. I don't know which one of those arguments is going to end up being true, but it's definitely, this is a big divergence, right? The other one is consumer discretionaries divided by consumer staples. So what people want divided by what they need. You look at it that way. So when the line is going up, the black line is the ratio. When it's going up, people are buying more of what they want rather than what they need, right? And the market tends to go up during that time. When the line's going down, people are buying more of what they need, right? If you're buying Campbell's soup instead of Tesla, the things aren't good, right? The market's probably not doing that well. And that's when the S&P 500 in blue is falling, right? So when consumer discretionary divided by consumer staples rolls over, it's a pretty good indication that there's at least fear in the market, right? And it tends to happen before the price of the S&P 500 rolls over. We had a kind of a double bottom here. So, we'll see. This is a reasonable place to get support on the ratio. And if the ratio starts moving back up, then the S&P moves up also. And then the last one is a lot more bullish, actually. This is high yield growth divided by basically cash. So HYG is a high yield growth, and IEI is a fund that's like 3 to 7 year treasury bonds. So it's very close to cash. And so when the ratio is going up, right, when this line is going up, it means people are investing in high yield, right, high risk funds more than they're investing in cash. If it goes the other way, people are reallocating to cash and out of risky high yield stocks or bonds. And you can kind of see when the ratio rolls over, it happens before the S&P rolls over. Okay. I'm saying it's a positive because we've been in an uptrend in the ratio. Even though the S&P has kind of been flat here since October, the ratio of high yield growth to cash is continuing to go up. Even as we had this little correction here in the S&P, investors are saying, nah, it's still risk on, right? So that's a useful ratio. It's a really good kind of risk on, risk off ratio. Okay, and again, the biggest thing, in my opinion, is the Magnificent Seven. If big tech rolls over, a third or more of the S&P 500 is made up of like 10 stocks. The other 900 or 490, a lot of them now are back above their 200-day moving average, which is great. But the Magnificent Seven is really, really important, and you can look at this a couple of ways. We had a low, and a low. So this is sort of a head and shoulders kind of pattern here. And if we break, we got support 3 touches on that line. So if we break to the downside, it's very likely that we come down at least to this high right here, at a minimum. On the positive, you could say we've consolidated. We can call this a consolidation range. So it's basically gone flat, but relative strength has come all the way down to being oversold. When relative strength gets oversold, that tends to be a bottom. And so hopefully this is a significant bottom that we just had, and the Magnificent Seven starts rallying. And if that happens, the S&P 500 should rip higher.
And that's what a lot of people are talking about right now. I like that it simplifies it for us as investors in the TSP, that we don't have to necessarily look at everything, right? It's nice to be able to just really focus on the S&P 500, and then kind of, you can take a look at, the iPhone and the S fund as a secondary, right? And kind of see how the market is being driven by the S&P. And and most of the analysts I follow are kind of betting on this. Again, nobody's got a crystal ball, but you can see it pretty clearly in the way Jerry just kind of showed this chart. And that's what's great about this. So you didn't have to go watch 6 different podcasts to figure that out. Jerry just gave it to you in like 30 seconds, where, most of the data, right? So this isn't guessing per se. Now, there is a little prediction involved because you don't know what's going to happen, but it would be very odd for it to go down farther. Speaking of RSI, right? And when you kind of back up, this is what's good about, we were talking about zooming out, right? And so instead of just focusing on the end of that chart and where it's going now, you zoom out and go, oh, okay, we got this kind of it's sideways movement, right? It's not really up or down. And the relative strength, which is a very good indicator, like Jerry pointed out, is pointing towards the bottom. So that would tend to, have us going up from here, which kind of falls in line with all the other things that people are talking about right now, right? And other historical things that Jerry just showed you a few slides before. So that's a good thing for us, I think. I think when people hear that, of course, it reinforces the positivity, right? The optimism, right?
Yep.
And investors stay risk on, right? And we use the term risk on, risk off. Jerry, give us a 30-second explanation of that, just so people make sure if they don't know what that means.
Yeah. Risk on just means that in general, people are buying risk assets versus defensive, consumer staples and things like that. Risk off would be you're buying bonds, consumer staples. Used to be precious metals. Now precious metals are basically a growth buy. But risk on, that's all that is. It just means that the sort of the investor sentiment is to be in riskier.
And for us, that would mean they're going to be in a CS&I. right?
Right.
They're going to be in the equities. They're going to be engaged. What level each one of those might be in your portfolio, you got to dig a little deeper, right? And do the ratios and different things, right? We've talked about those, but by and large, risk on just means you better be in CS&I or some version of that, because that's the direction it's going. And
Yeah.
so understanding risk on versus risk off is a very simple first place to start. And I think a lot of investors don't know that, particularly new investors. They don't understand. Just start there, right? If the market regime is risk off and you're buying the S&P 500, you're betting against just about everything, right? That's not a good bet. So just starting there is a great place to start.
Yep, absolutely. Now that I'm looking at this chart, I want to point out one more thing, because now that I'm looking at it, it's kind of glaring at me. We just talked about how the market can consolidate sideways, right? We are at a peak up here in relative strength, and we were at a top in the S&P, and then price went sideways. Relative strength came down, put in a low, and it's very possible that you get a break to the upside because relative strength is so low, right? It doesn't have to happen. And if we go back here, it's pretty similar. We put in top in December. The market went essentially sideways. I mean, it was trending down, but if you connect the bottoms, right? Relative strength came all the way down to oversold, and then the market broke down.
Right.
So
that's something I meant to say earlier. You just tapped into it. It could just stay down there, right? RSI could just bounce along the bottom. There's a few options here. I mean, we can continue to go sideways.
Yep.
And when you zoom in, it won't look sideways, right? But when you zoom out, it will. You'll be like, oh yeah, we're still kind of sideways, even though there'll be these ups and downs that we feel in the daily. Is this a weekly chart?
This is a daily.
Okay, so it'll be worse on the daily, right?
Yep.
In the weekly, it'll kind of ease out a little bit, but we could stay going sideways. RSI could stay at the bottom, and so again, yeah, it's good to point out, but the likelihood is the other way, but it can happen.
Yeah. I mean, for me, it's great because it gives you a place to get in. Say you want to buy the C fund here. I mean, there's nothing wrong with that, because if you are, so we gapped up here, we came down and put in a low, got support at that gap, came down again to the same level, came down again to the same level. So you would expect at some point we're going to get, well, either we're going to get support and it's going to keep going higher, or it's going to break through. If it breaks through, you just get out.
Yes, exactly. You've got an out point built in.
Yeah.
It goes below that line, get out. I mean, it's that simple,
yeah,
right?
And
that is the beauty of technical analysis, is you couldn't get that from just fundamentals. You can't. And I don't think anybody tries. I mean, most people that are, heavy duty fundamentalists still use charts to make the decision at the end of the day, and that's why, because if you bought right now and said, okay, I'm going to increase my, I don't know, I'm just going to make this up and say your portfolio is 50-50 right now. You're 50G and 50C because you're just feeling a little, I don't know what's going on, because it's been going sideways for a while. Now could be a time where you say, you know what, I'm going to go 100% C and this isn't advice, right? This is just an example. I'm going to go 100% C because of the setup here. Worst thing could happen is it crosses down through that line. Okay, it didn't work out, and I go back to G and I go 100% G, which you can always do, right? You can always reduce backwards. You can go 50% G until 75% and then 100%, right? In the TSP, we can go to G as much as we want, right?
Right.
So that's a good thing. So if you're in, you can always get out like that. And I think that's a great tactic, and it just depends on how confident you are in all the other aspects and data and whatever, to whether you say, okay, I'm all in. And it doesn't have to be all in. You might be 100% G right now. You say, I'm going to go 50-50. And you get the point. But this is the beauty of technical analysis. It's why we use it, and it's why we teach it on our site, because you can do some very simple, I mean, what Jerry just did with this, these basically two little data points, right? The price and RSI. There's some moving averages that help there, but you can see it clearly once it's pointed out to you. And we've got a whole course on how to build these charts, whether it's in TradingView or stockcharts.com. And it's not that hard. It really isn't, guys.
Yep. All right. Last piece. So TSP fund direction. We put a similar chart out a couple of weeks ago. This is the S&P 500 weekly. So each one of these red and green ticks is 1 week of price movement. Get the 20-week moving average line in blue. And again, the relative strength indicator here. The horizontal lines are Fibonacci extension levels. So they're very common. I'm not going to get into a whole thing about Fibonacci, but they're very common levels where when you have a big drawdown in price, once it turns back up and gets above the previous high, you can extrapolate how far a price is likely to go before it either hits significant resistance and or rolls over. Okay. So in this case, I did the top in January 2022 to the bottom in October 2022, right? So this was the one, this is the zero. When you use the tool, the Fibonacci extension tool, 1.618 is the most common place that you'll see either a lot of resistance or the market rolls over. So from on the 2022 bear market, the 1618 line, when price hit it, right, we had churning here, right? And then it broke above it and we moved up to the next Fibonacci level, which was 2.0. And that's when, right at that level is where we rolled over into the April bottom. Okay. So the next one I did was from the top in 2025 to the April bottom. And we have been butting up against this red week right there was the top in October. And we basically haven't made any headway since. We've been banging up against that 1.618 extension level since October on a big scheme of things, right? Obviously on the day-to-day basis, the market's been going up and down, but we have been on that 1618 extension line for months. So either it rolls over here or it breaks to the upside and the next target is about 74.50, let's say, at that 2.0 extension level. So it doesn't mean that it has to happen, but those Fibonacci extensions are great targets. And the only other thing I would point out on this is we would like to see momentum and relative strength increasing as price is trying to get up through that 1618 level. That is not what's happening. Relative strength is declining as price is trying to break through there. So it's just something to watch. If we get a breakdown through this triangle, I wouldn't want to be hanging out in the stock funds. Okay. You can kind of see the same thing here, right? As price is going up into that target area and relative strength is declining, it's not a good thing. All right, so that's the S&P. Bonds, I still think, are going to be the most important thing for the year. It is amazing to me that we are now 1, 2, 3, 4, 5, 6, 7, 8 weeks of bonds going nowhere. All the stuff that's happening in the world, and the bond market is going nowhere. It is astounding to me. At least it's riding on the top above that 50 line in relative strength, but it could certainly go either way. In the big scheme of things, we've been in this sideways consolidation, since the middle of 2022. We basically haven't gone anywhere. It's going to be really, really interesting to see because there's only so long. This is basically a big coil. It's just generating energy, and it's going to break one way or the other. If it breaks to the upside, that's potentially really good, right? When bonds break to the upside, it means interest rates are going down. If interest rates go down because the economy is doing well, right? The administration wants rates to come down. If the bond market agrees, GDP is high, everybody's employed, everything is good, rates come down, that's great for stocks and it's great for bonds. If rates fall because the Fed is trying to put a floor under increasing unemployment and a falling stock market, that's when you get the F fund spiking and stocks collapsing. So it depends why the F fund is going up if it does. If the F fund goes down, it means interest rates are going up. And that's certainly not good for stocks. So the fact that it's just churning right for a long time, it's going to break one way or the other. And there's no point in guessing, but it helps a lot to know to watch it, to see it when it happens, and then make adjustments accordingly. Okay, questions?
All right, guys, if you like what you see, please share this stuff with your friends. Subscribe to our YouTube channel. That helps us out and gets more of this out in the algorithm. If you see us on Facebook or Instagram, wherever you see us, if you have any questions or comments, you can always put them in the comment section wherever you find the video. If for some reason there isn't a comment section, you can always shoot us an email, support@growmytsp.com, and the support team will get it over to us. We hope you guys are enjoying the show. Again, best thing you can do for us is to share it with your friends. We do this every week. Obviously no cost. It's just a podcast we put out there for folks to learn how to manage their TSP. And if you like this stuff a lot, go check out our website, growmytsp.com. We got a lot of courses there, a lot of education, much more depth analysis. Our members get a really deep dive every Sunday, kind of sets them up for the week to come. It talks about what happened last week, and it really gives us, a strategy to follow. And at the end of the day, it helps you manage your TSP, and that's what we're here for. We just wish we'd had this when we were young government workers.
Yeah, for sure.
But we didn't. All right, guys, hopefully if you're in the Snowmageddon or whatever we're calling it, then you're safe and warm. And if you're not, enjoy whatever weather you got. And we will see you guys next week.
Next week.